According to some, the RBI's larger than anticipated rate cut came at the right time and is based on economic merit. But as Indian bonds drop the most in a month ahead of today's inflation reading, is the market still wanting more? BBVA's chief economist joins me down the line to discuss. Sumedh, as well as the cut, the RBI had succeeded in moderating consumer price inflation or retail inflation in the last few months. Therefore, analysts say giving a push to domestic demand to offset external demand through export contraction is the need of the hour. Do you agree that this is a turning point for India?
India is currently amongst the fastest growing economy in the Asia region, and thanks to concerted policy action from a reform-minded government and the Reserve Bank of India, India's macro stability and activity momentum has considerably improved. Having said that, I think India is still far from firing on all engines, especially on consumption and on investments. So I think ongoing policy efforts to fuel a more robust and balanced economic recovery is very important. And the government needs to tackle a lot of challenges ranging from the banking sector to plugging the massive gaps in infrastructure development, as well as, the reviving investment and consumption demand. In this context, I think it's imperative that policymakers utilize the available room for domestic demand boosting and through productive public spending and monetary accommodation.
What do you make of the suggestion, Sumedh, that the redemption pressures in global emerging market funds has come to an end?
We think global financial uncertainty would continue to persist. Investors are yet to fully price in the impact of three key events which we think will affect emerging Asian economies to a varying degree. The first one is the impact of China's slowdown and the prospective policy response by China's policymakers. Second is the Fed rate normalization, which has been postponed, but we do expect it to materialize in the near future. And the third most important thing we think is the deleveraging of debt amongst emerging economies. So these three factors will play out at varying pace and at different times in the coming quarters, and in turn it would impact the decisions of global emerging market funds.
One slightly negative note, however, is a recent report suggesting transmission in rates is being held back by banks, that interest rate cuts and hikes have been utilised by banks to absorb the upside and pass on the downside to customers. Is this really the case? And if so, might it push the RBI's hand yet further?
RBI's rate cutting cycle is not yet over. RBI noted in its last rate policy, where it cut rates by 50 basis points, it said that its stance going forward will be accommodative and the rate cut was front-loaded. But having said that, further rate cuts would be contingent on two main factors. First is how much the banks passed the bulk of rate cuts since Jan, and the second is the economy's ability to remain on the target disinflationary path. Coming to the first point, which the question relates to, currently about 50 to 75 bps of rate cuts have been passed by banks so far. But we must realize that, the bulk of the transmission still remains in the pipeline, and the reason why banks have been hesitant to pass it on is because their profitability is impacted, especially for the public sector banks, by high levels of impaired assets, weak capital buffers, and, subdued credit and deposit growth, which has hurt their profitability. So we think going forward, the transmission mechanism would be quicker because there has been policy efforts to aid bank recapitalization, reduce NPL levels, and adequate liquidity support provided by the RBI should help. So going forward, there is a chance of a rate cut, but having said that, it is contingent on how quickly the banks pass on the previous rate cuts into the economy.
India has actually pipped China to become the world's most attractive destination for foreign direct investment. As such, the rupee is expected to appreciate yet further this week as the Fed hike moves further and further away. With all that considered, what is your outlook for the INR?
So we did expect the rupee to strengthen given India's improving fundamentals, and we continue to remain sanguine on the outlook for the INR. We expect the rupee to strengthen gradually to 62.5 over a 12-month horizon, as we see global uncertainty fading and India's relative strong external fundamentals giving it an edge against other Asian economies. Also, the government's efforts to boost infrastructure projects and attract longer-term foreign investments, as you mentioned, should help the rupee. Having said that, I think the RBI would also be cognizant of the relative value of the rupee in terms of its foreign trading, in terms of its main trading partners, as well as its peer Asian economies. So the central bank would be very careful to counter a sharper appreciation of the rupee in real trade-weighted basis, because that would be detrimental for India's external sector and in turn on the economy.
Excellent insight there from Sumedh, but that's all from him and myself for the moment. But keep up to date on the latest currency movements by clicking back to Dukascopy TV. Bye for now.